Hello and welcome all to this Property Club introductory webinar. My name is Jake Sewell and I'm the branch manager for the Sewell branch. A couple of quick facts for you there just before we get going. So did you know if you're on that middle tax bracket earning $87,000 per annum, you're going to be working the first 2 days of the week for the tax man. Pretty scary thought, that one. And a lot of people think, investors aren't paying enough in tax. Well, there you go. 50% of state and local government revenue actually comes from taxes from property, whether it be stamp duty, land tax, etc. So property investors are actually keeping this great nation alive, well and ticking. A general disclaimer there, I'll let you read that one, but obviously this is just general information. Professional advice you should seek from the correct people. Just a quick background so you understand who and put a voice to the name, I guess. So there's myself and my wife with our young son there. That's a bit old, that picture, but same information. So myself, we have 6 properties between us with a portfolio of around about $3 million, and we're still quite young. Not massive income earners either, so using the strategies of the property club, we've been able to attain a portfolio that's still growing, and as I've mentioned, they're not huge income earners. I was a landscaper, my partner was an EA, so just average income earners, but we've been able to build this wealth through property since joining the property club and using its strategies. So for us, and a question you'd probably ask yourself, why do all this? And we wanted the lifestyle that comes with it. We didn't want to be working similar to what we've seen some of our close friends and parents do, working at the age of 70 or older. So we wanted to be able to, have the nice cars, and I'm an avid golfer, so being able to play golf and go on holidays, even if it's spoiling the grandkids. So I'm sure we've all got these lifestyle choices that we'd like to be able to have in life, and how are we going to be able to accomplish those. So something to look at: how much money are we actually going to need come retirement or to start living that lifestyle we want? I don't like the word retirement too much because it's appeals to the older group, I think. I think lifestyle is a good word for that too, and I can't see myself ever fully retiring. I'd still like to maybe work at Bunnings or something like that, but let's use the word lifestyle for the remainder of this short webinar. So quick facts there: average life expectancy for male 81, 85 females. So how much money are we going to need? Now this is you can go to the ASFA website and have a look at this. That particular number there shows $60,000. Now that's for a comfortable lifestyle for a couple. You can see there's a few assumptions. Your house, obviously, you'd own that outright, but not a huge amount. You're spending there on, clothing. I'm sure that number's a little thin for many of you. My wife is included in that. So let's look at the assumption of $60,000, and that sort of gives you a comfortable lifestyle. Most people will want more than that, but we'll work off those numbers for this demonstration. That's the number there I've highlighted. So retiring at 60 and living to 80, as we saw, the average age of a male is 81, needing $60,000 a year, that's $1.2 million. If we're going to start our lifestyle a little bit earlier at the age of 55, $1.5 million. Looking at that graph there, we can see only 5% of the population actually retire or transition into that being financially secure. You can see the large majority there will end up on welfare. So what is welfare, or the current age pension? So you can see there the statistics, 23 for a single, $35,000 for a couple, so well short of that $60,000 figure we were working off there before. And how about super? Well, you can see the current statistics of the average super balance at retirement, and male there with just under 300,000, the female with just under 140,000. So that's divide that by 60,000. It's not going to give you a huge amount of years living that lifestyle you want. It's going to run out very quickly, and then we'll be back on that $35,000 pension. Those ads always make me laugh. Those particular ads, if you've seen them, and they're talking about making the switch to a different super fund, and over 10 years it's made $30,000 difference. The grand scheme of things, not a huge difference there. So they're quite comical, those ads, in my opinion. So what's the best solution? So at the Property Club, we believe it's investing in property. And why property? Why do we look at property and not shares and other forms of wealth creation? Well, high leverage is available with property, meaning you can borrow a large majority of the asset compared to other forms of wealth creation, like I mentioned, stocks and shares. So instead of putting in more money yourself, the bank's willing to lend you a larger percentage of that because they see it as a low risk, or a lower risk than other investment strategies. So that should give you some comfort also with investing in property. Historically, long-term capital growth, if we go back as far as statistics have been kept, we can see that property has always performed well and will continue to do so in the future. As mentioned there, minimum no cash. So if you do have existing property with equity in it, you can actually leverage off that equity and further advance your portfolio of properties. First-time buyers will need some cash unless they're lucky enough to be given a gift from Bank of Mum and Dad, I like to call them. But those of us with equity in our properties can do so without any cash required. Don't forget, you've also got the rental income and the tax savings coming in. So those two, especially the way interest rates are at the moment, offset your mortgage repayments. So little to no holding costs of a property. And as mentioned, it's relatively low risk compared to other options. So that's a good one to think back at. What do you think your parents paid for their home, and what is it worth today? So many of them have probably sold, moved out. But if you think back to, and one of those properties there will probably look fairly familiar, whether it be the old brick home or the Fibro Queenslander. But think back to what they might have potentially paid for their property years ago and what it'd be worth today. I bet they wish they still had that property, or you had received that property from them. That's the power of property. So here's a couple of quick facts for you. We touched on a couple of these at the start just to get those brain juices flowing, but 50% of state and local government revenue comes from property taxes. Look at those numbers there. Now this is taken just recently, but each year investors $8 billion in stamp duty, $7 billion in land tax, and some 130 million in council taxes. So it's a huge revenue earner for the government, and you think how many projects they can achieve from that. So all these sorts about tampering with negative gearing and pushing investors out of the market, not really what they want to be doing. As you can see there, how responsible it is for keeping this great nation alive. I saw this picture just recently. I find it quite interesting. There's more people living inside this circle, as you can see there, than anywhere else in the world. So Australia really is becoming an area for overseas migration. We're seeing the population move quite quickly, and that's a good illustration of why that is happening and will continue to do so. Apologies, not the cleanest graph there. Quite difficult to find this sort of data that goes back as far as this one. You can see their property prices don't go in a linear line. They're up and down, but over time they do go up. We can see those world events, local events that have occurred there, which can seriously impact property prices. But over the long term, which property investing is, it's a long-term strategy, we can see there that prices continue to go up and will do, providing you hold on to that asset long enough. When we spoke about leverage, I'm going to give a quick demonstration of what I mean by leverage. looking at some scenarios here. So let's assume we have $45,000, whether it be cash or equity, in a property. Now, if we were to keep that in, say, a term deposit, earning a slight amount of interest at $45,000, it's not really going to do much, is it? It might achieve some small increases, but over time, bank fees, etc., not really going to do much there. A non-depreciating asset, we like to call them, like a car or a boat. Some are necessities, but they're not investments, are they? So you could buy a nice Nissan Navara or whatever you're into for $45,000, but in 20 years' time, the value of that's going to diminish. You can put the money into your super, and it will double over time. That's assuming you're still contributing into that. So it is an option, but we all know the limitations there are with super and accessing that, and that is getting more difficult each year, it seems, as well. So for myself and many of my members, super is not an option. Property is my super, and I'll continue to invest in property for my wealth. So let's now take that $45,000 and using other people's money. Okay, so that's the bank. So with that $45,000 and the loan we've been able to achieve from the bank, we've now been able to get into an asset worth $450,000 with that same $45,000. Now, as I mentioned, property values don't increase in linear movements. It's up and down. But if we look at historical data, going back as far as you can go back, sort of the 1950s, and even in recent times, the average property is doubling between 7 and 10 years. We're going to use 10 years here as the example. So within 10 years' time, that property you've purchased for $450 is now worth $900. The debt is still the same, as we're just paying the interest component on that loan. So we now have $495,000 worth of equity created by that one investment of $45,000. Fast forward 20 years, that property has since doubled again. We still have the same existing debt to that property, thus creating us equity in that property of $1.4 million. Now that's with one property. You can't get rich with one property. It's about building a portfolio, but you can see there the power of leverage and what it can do for you. As mentioned, this is using a 10-year doubling. If you wanted to be more conservative and use 14, 16, 20, whatever it may be, it's still a much better option than anything else. This is one of my favourite graphs here. So I mentioned briefly that it's a long-term investment property, not a get-rich-quick scheme. Okay, so it is about holding onto that asset for the long haul. This is a statistical data from CoreLogic, which encompasses all properties in Australia and their values, resale values, etc. And we can see down the bottom right-hand corner there, if you've held on to that asset for 15 years or more, 95% of the time that property has at least doubled in value. So that encompasses all properties, mining towns, less desirable locations, including the capital cities as well, where we tend to see more growth. But you can see there, 95% of the time, if you've held that property for 15 years or longer, you've at least doubled your value there. The key to this is diversifying. Okay, so we can see it's not about just buying in your if you're from Queensland or from New South Wales, you wouldn't have all your eggs in one basket. With investing, the key to any good investing is being able to diversify. So, and that's particularly true with property. So property cycles, as we know, grow at different rates at different times. At one particular moment, New South Wales might be the flavour. Next one may be Melbourne, from there Queensland. So by diversifying, you're riding out the highs and the lows, and they help balance each other out, not only with capital growth, but also rental yield, etc. So it's important to diversify three things: where you purchase the property, what kind of property it is, and also potentially what lender you're using. It's all about spreading your risk keeping it as lower risk as possible, and diversification is a big key of this. A very brief look at the property club game plan. Okay, so what we're doing there, the blue column you can see there is the debt on the property. So as per the previous example we looked at, we weren't actually paying down that debt. We were just paying the interest component. And because the debt remains level, we can see there the increase in value over time of that property. As mentioned, it's not linear. It can be up and down and sideways, not so much down, but it can stay flat for quite a period of time. But if we look at averages, that's how it works out to be. So the debt remains constant, and it's that increased value or that equity in those properties there that we're after, and what makes property investing so successful. So why is Property Club the leader? Myself and my team of mentors, we have all been members of the Property Club and purchased properties through the help and guidance of the Property Club. So we're not actually salespeople. None of us have real estate licenses. We're not from a sales background. We've just been, we've come through the Property Club with our own mentors. We've achieved success, and we now want to pass that on to other people to help achieve the prosperity we've been able to, and it helps keeps us motivated as well. So we really enjoy what we're doing, and we're here to help you. We have a Property Millionaires Club. You may have briefly heard about this before, which is almost up to the 6,000 mark. That's members of ours who are able to purchase a portfolio of properties with the value exceeding $1 million, which is a fantastic achievement. And with that comes advanced learning and strategies, and a large group of like-minded people. It's a fantastic club to aspire to and be a part of. We have 80,000 members. What that means is that's extreme bargaining power. So when our researchers are negotiating with the vendors, because we have such large volume of members, and we can sell a large number of properties at once, it's the old Kmart principle. So the more sales, the heavier the discounts, and that's why we're able to offer you such great deals. And we've been going for 24 years. There's many fly-by-night properties clubs that pop up. 2 or 3 years later, you'll never hear from them again. So we've been going for a long time, and it's that stability that really drew myself to the club, I guess, when I started out some 8 years ago. A quick look, there's many advantages with the Property Club. I'm just going to highlight a couple that really appealed to myself, and I think probably a big key to the success of why Property Club has been so good and continued to be for our members. We have a research department fully dedicated to finding the best residential investment properties throughout Australia. We've got over 30 of them, and they're Australia-wide. As I mentioned, it's about diversification. So we're not just looking in 1 or 2 states, we're looking across the 5 major states. So we all understand how much research is involved just looking at one property. Trying to be an expert on all the areas, not possible. So that's why we have this group of researchers doing the hard work, the negotiating for us. So very strict criteria to get properties listed through the club. I know there's many builders out there who actually get quite frustrated with how difficult it is to get listed, but the thing is, we want you to hold this asset for a long time. We want the property to be built correctly, good build quality, etc. So that's why we're so strict with our listing criteria. A couple of things there the researchers also look at. There's many more, but where's the population movement going? Because population movement is going to, in turn, improve rental yields, which of course is going to push up the value of the property. So where's the population movement going? What sort of infrastructure is in place? And it needs to be close to, education, healthcare, schools, transport, all those desirables that we're looking for to make that property appeal to its tenants. So all of that at no cost as well. like I said, this is their only job, these researchers, residential investment properties. If they're not finding the best properties, they're not going to get sold and they're not going to get paid. So it's in their best interest to find the very best properties for our members. And one more department, the Property Club Leasing Department. So what they're able to do is keep your rental vacancies down to very low. They're much lower than industry standard. The way they're able to do that is we can help you insert certain clauses into your rental agreement, which then allows us to multi-list that property with multiple agents. So let's say the tenancy has expired, the existing tenants aren't going to stay there. Instead of just staying exclusively with the one agent and potentially having a long vacancy, we're then able to list that property with multiple agents. They're then in competition with each other, and you'll tend to find that you'll get a tenant much quicker if there is a vacancy at all once they're in competition. That's all free to you as well for the life of the property. You could have the property for 20 years. Tenant might have just moved out. We can multi-list the property and get you a tenant straight away. You will still be in charge of the approval process. So once the applications come through the leasing department, your mentor would then pass on that application to yourself to have a look at. So you will always have control over who is moving into the property. It's a great system. I can say with my portfolio of properties, I think I can count on one hand the number of days vacancy I've had over the 8 or 9 years I've held those properties. So it's a fantastic system, and it's unique as well. There's no one else doing this in Australia. So what's your next move? One is to complete. You need to know where your finances are at and if you have the ability to be able to start doing this. If not, the broker who you will discuss this with can offer some strategies and some advice how you might be able to consolidate down some debts to improve your borrowing capacity, potentially even save you money on your existing loans. So I'd really encourage you to do one of these now. There'll be a link on this video to download the form, complete this and return it through to your mentor or your broker. If you don't have those details, please just contact myself. I will supply the email at the end of this webinar. We also have a number of upcoming events, which I'll share that link as well on this video. It'd be great to have you along to those. Most of them are free to attend, and we'll be going through more advanced strategies and also looking at some specialized topics in that. Thanks very much for watching this brief webinar. I hope you gained some knowledge from it. We'd love to see you along at one of our Property Club events very shortly. Please download that wealth check form and have that completed. It's free. There's no obligation. It's a conversation starter with the broker, and it will at least give you an idea of where you're at from a borrowing ability, and then we can start looking at what your options might be. Thanks for your time. Again, my name is Jake Sewell. My email address there is below. If you've got any questions, please don't hesitate in contacting me, and I'll look forward to seeing you at a Property Club event very soon. Thanks very much.